Welcome to another Legacy Virtual Friday Masterclass. And um, I see some friendly names and faces on here. And it's good to see you guys. Appreciate you guys taking some time and spending some time with us on your Friday morning. So we've been hosting these since the beginning of January. I intended to only do one in all of January and do like one a month. And then it turned into two a month, and now it's every single week we're doing these. And so um, I appreciate you guys being here. Many of you have been here for every single week. And we started out doing a state of the market the first week in January. Then we talked about acquiring and underwriting commercial real estate assets. The second week in January. Last week was all about branding, personal branding, building a personal brand. This week is all about money. It is how to passively invest in unlocking wealth and really opening your eyes to what we've been told how we should be investing and how we're actually investing. So I'm really excited to kind of help unlock the truth for you guys over the course of the next couple hours here. So we run these every Friday from 10 a.m. to 12 noon Eastern time. And if you're not already registered, make sure you register for the upcoming events. We have next week, I'm going to be on site at 10 a.m. Eastern time at one of our townhouse developments. And so we'll be walking around. I'll be interviewing my team. My COO will be there. We'll be talking about the construction process and what it's like doing ground up development. That'll probably be an abbreviated one since I'm going to be out and about. So it'll probably just be about an hour from about 10 a.m. to 11 a.m. Eastern time. That's on February 2nd. February 9th, I have my good friend Scott Hannes, who used to run a private equity firm. Actually, let me back up. It's all about team building. We've had the success and the ability and the blessing to be able to hire a lot of people and employ a lot of people. We probably have, I don't even know, we manage in-house around 1,500 doors. So not including even the employees that we have that are third-party managed or anything like that. We probably have north of 120 employees between my investment company, my other companies on the business side, and then the education company, and then all the property management staff and stuff that we have. So we've been able to build up a pretty substantial team, and in multiple different verticals and different businesses. And so I'm going to have my COO on, Matt Carlin, talking about team building. I'll have our chief HR officer, Scott Hannes, on. Scott has his own business called Fortitude HR Solutions, where he used to run a $2 billion hedge fund. It was in charge of human resources for over 900 employees, and now he does it for small businesses. So I have him coming on. Angela Dunn, who is, if you're familiar with Kelly Garrett, her COO, and she's an absolute rock star. On that side, we'll do some panels and things all about team building, cultures, organizational charts, key performance indicators, how to hire, how to fire, all those kinds of things. Then on February 16th, we have a discussion. It's all about free money. This will probably be interesting for a lot of you guys. It's all about free money. So we'll be talking about tax credits, how to gain access to grants, a little bit about the ERC and SETC stuff, which came out of COVID, where it's essentially free money that you have access to, and a lot of people don't even know that these things exist. But how do you gain access to historical tax credits, conservation tax credits, government grants, some of these other things that change on a year by year basis? We'll be talking about tax strategy and all sorts of jazz during that one too. And then on February 23rd, a little bit different than this one. This would be heavily about passively investing in real estate and kind of unlocking the truth on investments and the psychology of money. We're going to do, I have a good friend, Steve Enriquez, who is a chiropractor, and he's in this white collar trade, right, of doctors and dentists and people who make a lot of money trading their time and trading their time for money, though, right? And so how do they get out of this? How does anybody, you could be a business owner trading your time for money. How do you get out of this kind of hamster wheel of trading your time for money and get into really scaling your wealth, right? And so we'll be talking, that one's going to be called white collar wealth building. And it's going to be A few simple processes that Steve and I sat down, talked through, like what are the most important things. And I haven't had this conversation only with Steve. I've had it with many other people that are doctors and dentist friends of mine. And I think there's a couple of very simple things that can be done in order to, for instance, own your own office. If you don't own your own office and you're renting space and you're a business owner, there's a problem with that. Like you can very easily start increasing your wealth, saving a little bit of money, turning a liability into an asset if you own your own office. I think there's things like that that are very easily implemented for a business owner where they can have a little bit more control over their wealth. We'll also be talking about how to build your business to sell it, right? Putting certain systems and processes and procedures and people in place where even if you are kind of a solopreneur or a white collar professional, or you have some sort of a business where you are actively have to work in it, we're going to be talking about how to automate, how to systematize that business, and then set it up for a sale in 3 to 5 years for a way better multiple than if you sold it today. And then what to do with those funds, right? Different opportunities, different ideas on things to invest in as well. So that'll take us through the end of February, because the last week in February, I actually have my Legacy Summit out in New Orleans. And that Legacy Summit is only for my mastermind members. If anybody is interested, and by the way, we don't sell anything. It's not like it's totally a fulfillment thing for my mastermind members. And so it's just a ton of networking, discussion panels, speakers, and that topic and the theme is all about show me the money. So we have speakers on financing, gaining access to financing, being more bankable. And we have actually we'll be talking about self-directed IRAs. You're going to get a little bit of taste of that today with Amanda Holbrook at Specialized Trust Services. We'll be talking about how to raise that money and then deploy it and access some of those accounts, both a little bit today, but real heavily at our summit. And then we have actually one of the folks that's talking on the gaining access to free money. Mr. Shakowitz will be actually talking about a little bit more of that and diving deeper into tax credits and grants and things at our summit. We have a discussion panel on passively investing in alternative assets, including crypto and businesses and things along those lines. Talking about tax credits, tax liens, tax deeds, and then another thing that we're going to be doing is actual workshop where my members are going to be bringing their profit and loss statement to the summit, and we're actually going to take about an hour and a half to go through and trim fat and find places in their income statement where they can increase margin by anywhere from 7 to 10%. So if you got a $1 million business and we can help trim, let's call it half of that. Let's say we can help trim 3 or 4% of fat and increase margin by 3 or 4%. That increases your net operating income by $30,000 to $40,000 at the end of the year. So we have not done this before, but we're actually going to open that summit up for anybody who might be interested. You're welcome to attend and buy a one-time ticket as a kind of a trial of the mastermind. See if it's something that you like. That way you don't have to commit for the entire year. You can come out. You can only do this one time. You cannot come to every single summit. But if anybody is interested, we'll share the link and you can come out to that. Learn a little bit more information about it. Hop on a call with either me or one of my partners to learn a little bit about it and actually select and purchase a ticket to that event. So that way you can meet everybody. And if it feels good, we'd love to invite you as an annual mastermind member as well. So that's a little bit about what we have coming up, and super pumped for it. But today is all about passively investing. I'm going to spend the next, I don't know, probably 20, 30 minutes on all about kind of the smoke and mirrors in the traditional finance world and kind of unlocking the truth. I also spoke to a gentleman named David Karp and heard him speak and got to chat with him a little bit further. David Karp owns a Fortune 400 company that is a financial advising firm, but it's more fee-based. And he manages 160 people's wealth, only 160, and it's $43 billion. And he shared 7 different steps to the psychology of money that I'm going to share with you guys over the next 20 minutes here. And then I'm going to hand it over to Amanda Holbrook, who's going to talk a lot about how to tap into the trillions of dollars in retirement accounts through self-directed retirement accounts, and how to utilize that and deploy it into different opportunities. And then I'm going to bring up Fatty Bulmitri, my partner, chief investment officer, talking a little bit further about kind of the differences between debt investments, equity investments, and some of that stuff. And then I'll come back and share an actual case study and talk through some hypotheticals on a case study that we recently did, that you can see what that's like. And then we'll have a little bit of Q&A probably at the end of each section. So with that being said, I am going to dive into my slides. I got a lot of stuff I want to go through, but I don't think I'm going to go through all of it. I don't have time to go through all of it. But take pictures, take notes. Any questions you have, put them in the chat box, and we will rock and roll from there. All right, can you guys see this? Melissa, I see you on here. Can you just give me a thumbs up? Yep, all right, awesome. All right, let's go. Oh, this didn't come out in order, but there's 3 simple steps to building wealth. This is in my kids' books, right? Number 1, you got to earn money. People typically don't have that difficult of a time earning money. Number 2 is saving money. People have a little bit harder of a time saving their money, living below their means, right? Especially in the United States, where we see it all on social media, where the more material stuff you have, the further along you are. I am very, very against keeping up with the Joneses. I have an awesome house, but I do not give a crap about most other things. I really, I am very frugal in the way that I save money. And then number 3, even fewer people. A lot of people earn money. A fraction of those save money, and even a fraction of those people who save money actually invest money and understand how to multiply their money. You see, we're all told to go and take our money and throw it into a mutual fund or into the stock market. But there's a lot more that comes with investing money than just that. And I'm going to show you a couple things and open your eyes to a few things that you probably have not heard before. So this is the S&P 500 from October of 2002 to October of 2007. And what I want to point out here is the market rose in this 5 years by 100%. The average investor who lost a bunch of money in the dot-com bubble burst made almost all of their money back over the course of that time, right? Over the next 5 years. But look at what happened over the next couple of years. Over just 2 years, the market lost $11 trillion in just under 18 months. The average investor lost 56%. If they started out with $241,000 in 2002, it would have grown to $431,000 by 2007. Over the next 18 months, that $431,000 dropped to $186,000. Here's what I want you to understand about real estate markets. When you sit down with your financial advisor, they sell you based on the average return that the market has produced over each year, right? So they say, oh, we've been in business for 80 years, and here's what the market has done every single year, and we've averaged 7.5% every year the market has averaged over time. Here's the reality. If you have $1 million in a bank account and the market goes up by 20% and back down by 20%, you don't have $1 million left. You have $960,000 in your bank account. But the financial advisors don't want you to know what it does to your actual dollar amount. Look at it increased, this market during this 5-year period increased by 100%. And then it only dropped by 56%. And look what it did to the dollars that were in your account. But if you go to the if you go to the financial advisor, they say, no, we increased by 20% a year, this and that, and all these other. That's why they sell you on average annualized return, not based on what it actually does to your dollars. Let me dive a little bit deeper. Know what you own and know why you own it. Famous investor Peter Lynch, multi-billionaire, said that. Your stock portfolio, for instance, has a standard deviation of risk and what the annual returns can and how they can change based on diversification, right? Well, if you have one stock, standard deviation is you're kind of flipping a coin 50-50 on what it can do. Once you have 30 stocks, that is reduced down to about a 20% standard deviation of going either way of what you're expecting to return. Look at what happens when you go to 1,000 stocks. You only save another 1.5% of standard deviation. Do you know what these 1,000 stocks are, what these 1,000 investments are, what these thousands of places that you have your money in are? No, not necessarily. And as Peter Lynch says, know what you own and know why you own it. I'm a big believer that diversification up to about that 30, 35 investments mark and knowing what those investments are is far better than just throwing your money into mutual funds where you have no idea what they are. You have no idea who's running those companies. You have no idea if they're cheating emissions tests, right? Like Volkswagen did. You have no idea if there's a Me Too movement or some other crazy stuff that can happen that are completely out of control. And instead of just throwing it out across all these different things, know what you own, right? And know why you own it. Look at what happens going back to the idea of the account balance versus account returns. So this is what happened each annual year from 2000 to 2019 or 2001 to 2020, whatever it was. But these are actual returns year by year from 2000 to 2020. If you started out with $1 million balance, this is what the S&P 500 kicked off each year. Okay? So in 2000, 2001, 2002, 2003, this is what would have happened to your account balance. I only want you looking at this left-hand column for now. After 20 years, that $1 million still would have been $3,078,000. You see, if you look down here at the bottom left, it says 7.36% was the average return. And this is what a financial advisor would sell you on. But what happens to the actual money is just over $3 million. Okay, so you triple your money in 20 years. Versus, look in this middle column where it says return, 7.36%. If you just got a 7.36% without the roller coaster of money up, money down, because remember what it does to your account balance. Every time it goes up and down, which it does multiple times a day and dozens of times throughout the year, right? Every single time that it does it, it hurts your actual dollar balance in your account versus getting a fixed return of 7.36%. That same 7.36%. So if you invested it in something that gave you a predictable return of 7.36%, that $1 million in year one would be just over $1,073,000. Boom, 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 boom. And look at how it adds up, where you don't have the variability in it. And look at what it does to your returns. You end up with 4.135, an extra $1,056,000 because you put it into a fixed rate investment. The difference is considerable. It is actually better. What they say in the stock market, it is better and about equivalent to about a 4% annualized return on your investment over time. 4%. You just need 4% without the ups and downs in your investment portfolio, and you can beat the S&P 500. Take a look at this. This shows what the return is. And let's say you're at an age where you need to start pulling money out, or you want to live off of these funds. And if you've pulled out $15,000 a month, and maybe it's more, maybe it's less. I used 15 grand. and you started out with $1 million and you pulled out 15 grand a month, but this is what happens to the balance. It's in year, I'm sorry, there it goes in year one. So this is age 35 to age 54. So the first, let's say you're in your mid 30s until your mid 50s, and then mid 50s to your mid 70s. So it's actually a 40-year time horizon. And I'm sorry, you didn't start taking out money until over here at your 55. You see the account balance, and what I did is I took the percentages in return one, and I took from 2000 to 2019. All right, and the actual returns, and then I flipped it to see if there was any difference if you started out with a win, then I went backwards. Does that make sense? And at the end of the day, the return is exactly the same, whether you start out with a big win or you start out with a loss, but then you catch up a little bit later. The what it does, your dollar amount is exactly the same. However, if you start pulling money out, let's say at the age of 55, and you want to start pulling, 15 grand a month out to start living off of because you're retired now, it makes a big difference whether you start out with a win or whether you start out with a loss. So if you start out with a win, your account's growing, you're able to pull some money out. Yeah, you lose a little bit of money, you make some money, and you still end up ahead of where you were, even with pulling cash out of your account, if you start out with a bunch of wins in a row. But if you start out with a bunch of losses in a row, depending on timing, and I don't know about you, but I don't think any of us are Nostradamus where we can time the marketplace. And we don't know what's going to happen year over year over year over year. Obviously, things are cyclical, but it's not predictable. And if you risk going into something that does lose money and does lose principal value for a couple of years in a row, look at how it adversely affects your account balances. And even though you got some big years a little bit later on, you end up losing and having a negative balance and having to go back to work by the time you're 70 years old because you started out with losses versus wins. Your financial advisor doesn't tell you that kind of stuff. The other thing that they don't tell you is the impact that fees have on your return. There's a lot of fees kind of in the small print that are not disclosed from your financial advisors. And so if that $1 million up to 3.186 million had zero fees, that's the dark blue, kind of a indigo purplish line. If there was a 0.5% fee, 1% fee, 1.5%, and 2% fee, look how much it adversely affects your overall gain. If you have a 2% fee, they're taking $1 million. You're reducing your gain by $1 million over that 20-year period. Know what you own, know what it is, know why you own it. We're going to be talking a lot about fixed income and predictable preferred returns on cash flowing real estate assets. That's what we're primarily focused on. That's why I'm so passionate about real estate, is because real estate, put your money in, it's backed by a fixed asset with predictable cash flow that kicks off a certain dividend that's very predictable year over year. Not only that, but there's also tax advantages like depreciation. You can 1031 exchange and all sorts of other benefits to it. I could dive into I'll dive into the psychology of money just because things are tight, but I'm going to be diving into this a lot deeper. I'm going to go surface level for you guys real quick over the next 5 minutes on the psychology of money. There's a book about this, and this is what David Karp, the owner of Crescent Capital, who manages over $43 billion of assets under management for ultra high net worth individuals, shared with us about a week and a half ago. And so first thing is respect luck as much as you respect risk. We all talk about risk, but at the end of the day, when you put your money into that account, and whether you had a big win the following year or a big loss the following year, chances are there's some luck that comes with it, right? And David had mentioned something. He said, "The luckier you are, the nicer you should be, right? Because you don't know what it's like when you don't have luck and how you treat those people. So the luckier you are, the nicer you should be." There's a famous quote that says, "How do you spot an idiot? You look for the cruelest person in the room." Right? So always treat people well and respect and appreciate luck just as much as you respect and appreciate risk. Number two, boom and bust is inevitable. That means it always happens. We are always in a boom or a bust or an in between, but it always happens since the beginning of time. There's always been upsides, downsides, and in the middles. Getting rich requires taking some risks, right? Starting a new business and hiring employees and a lot of those things. Staying rich requires a lot of frugality, right? Keeping your money, saving your money, and almost paranoia that you're going to lose it, right? Making sure that you're putting it into very predictable types of investments and things that are tangible, things that are fixed. Staying rich is all about being financially unbreakable and leaving room for error. I think it's a very important part of that is make sure you're always leaving room for error. Hey, I expect an 8% return on this. All right, let's leave 20% room margin for error, right? That is the standard deviation, assuming you're diversified, of another 20%. And if you can live on what is it, 6.4% return, then you're in a pretty good spot. All wealth is relative. This is a tough pill to swallow, especially in the world of social media where everybody's talking about the jets that they're flying on and the new watches that they bought and the trips that they're taking and the houses that they're buying, the cars that they're driving in. But the reality is when I got started in business, I wanted to make 100 grand a year. That's all I wanted to make. Right. And I kept on moving the goalpost and I didn't get any happier after I made $100,000. So understand that this is a journey, right? There's not a tip of a mountain. It's more important to understand that in life you might hit certain checkpoints in life, but there's not a final destination, right? You might hit that goal, you might check that box, but it always keeps going thereafter. And I think gratitude is the key to success, the key to happiness, right? Comparison is the thief of joy. Gratitude is the feeder of joy. Makes you a lot happier if you're thankful. So stop moving the goalposts. Appreciate what you've got. Define what enough means for you, so you don't have to take unnecessary risks. Hey, worst case scenario, if I can get the house paid off, the car's paid off, I can set this much money aside. Won't affect my lifestyle. This is the return that I need to make. And these are the risks that I need to take in order to hit that return, or the risks that I don't have to take because I don't need a higher return. Right? Weighing that out, I think, creates a lot of awareness, personal awareness, financial awareness for you, and keeps you at a very smart decision making level. Next one is there's rich and there's wealthy. See, rich is buying nice stuff. Rich people buy a lot of nice stuff. Wealthy people are independent. Wealthy people are not subject to being in any certain place at any certain time. They're free, right? They use their money to buy time. That's the one resource that none of us can get more of. But there's certain things that you can outsource so that way you don't have to do them and you can create more time to do the things that you enjoy and be with the people that you care about, right? So you hire somebody to do your landscaping. You hire somebody to clean your house. You hire somebody to cook your meals. You're buying back time. And wealthy people are independent and they're not time constrained. This is a really powerful quote. Every dollar of asset that you own, every dollar of an asset on your balance sheet is part of your future that you own. Every dollar of liability on your balance sheet is part of your future that someone else owns. I'll say that again. Every dollar of asset on your balance sheet or in your net worth is part of the future of your future that you own. But every dollar of liability that you have is part of your future that someone else owns. So you got to get rid of those liabilities. Number 5, have a plan. Plan like a pessimist, live like an optimist. And plan on the plan not going as planned, right? When times are good, you build a surplus because, number 2, boom and bust is inevitable. Times will not always be good. So that way, when times are good and in normal times, you always build a surplus. So that way, you have a stockpile when the times are tough, when the times are bad. Risk. Risk is what you cannot see. Risk is what's left over after all other variables have been accounted for. You got to plan for the downside, but work the upside. Build up your chip stack as much as you can. So again, you have that stockpile of reserves for when the boom and bust cycle comes again. And finally, being average consistently over time is far better than being above average over a short amount of time. That's proven in those examples that I just shared with you of ups and downs and booms and busts and short bursts of big returns. If you're just average consistently over a long period of time and your money working for you hits an average return consistently over time, you will be far ahead than somebody who's chasing get rich quick opportunities. Don't be reckless. Don't be a pig. Don't be greedy. Find investments that have predictable returns over time consistently with little to no risk to principal. That is how you build long-term wealth. So I have some risk mitigation factors, but I'm going to share those later because I'm a couple minutes over time. And I want to make sure that you guys get a ton of insights from my friend Amanda Holbrook. So Amanda has been in the self-directed retirement account space for 15 years. Yeah. And so I've known Amanda for a long time. I know she does a rock star job. She's part of our mastermind legacy family and an integral part of that mastermind too, because she understands self-directed retirement accounts. And there's several other types of accounts that you can self-direct where you can either tax defer or build wealth tax free through these different vehicles. And there's trillions of dollars in these different accounts in the United States that are completely untapped. So if you understand how to educate somebody on this or where to point somebody to get educated on this stuff, they can then tap into funds that you can then utilize to invest in assets, right? If you have your own accounts from previous employers or previous jobs, you can tap into those and invest funds that maybe you didn't even think was possible to self-direct and put into a real estate investment or to buy gold with it or to buy whatever you want with it. And so what I'm going to do is hand this over to Amanda Holbrook. She is an absolute all-star. Amanda, take it away.
Oh, thank you. All right, everybody can hear me? Good, good. Okay, thumbs up. All right, let me share. If you see me looking around, I do have like space command post over here. Make sure I'm sharing the right screen. Okay, there we go. Everybody good and good? All right. So Tim, I jumped in right when you were, I mean, it's like you saw some of my slides. And full disclosure, he did not. So I love it because we all sing the same song. So thank you. I appreciate everybody that's on here today. We're going to go over some nuggets and some great Q&A. So the big takeaway here is diversification, right? So we're going to hop right into that. So specifically, I want to talk about self-directed diversification, obviously. Okay. But before I can do that, this is legal. They make me do this every time. So specialized trust companies, a passive custodian would recommend or endorse a sick investor, investor sponsor. We're not attorneys, not CPAs, no tax advice, legal advice, blah, 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 blah. We're a passive custodian. Okay. All right. Now that that's out of the way, thank you again for having me on. A lot of you know me, a lot of you don't. So I'll introduce myself. I don't like talking about myself. It's awkward. So awkward handshake over the Zoom, complete. As you so lovely pointed out, Tim, I have been doing this for 15 years. Long time in the industry, in and around real estate of all shapes and sizes, you know, so bringing that wealth of experience to you guys to make changes, grow and scale your own portfolios and businesses. That's my superpower to the family here. Okay. So what we're going to start with is know your enemy. Who is working against you? And you touched one of them as far as fees are concerned. And I'm going to touch on that because I feel like folks in our arena, they don't bring that up enough. You know, but the two big enemies I'm talking about are inflation. You know, inflation, guys, I mean, a dollar today is not a dollar tomorrow. You are seeing it all over. If you're looking and watching anything in the economy, your dollar is not going as far. Retirement accounts are getting, you know, tighter. We're seeing personal debts and those liabilities skyrocket. All right. So, you know, and you hear the R word, you know, recession, right? So how can you help recession proof is what we're going to talk about today, or inflation proof? You know, there are tried and true, history always repeats itself. One of the huge tried and true investment classes that hedge inflation is, wild guess, real estate, right? It's tangible, it's insured, everyone needs a place to live, right? So we're going to touch on that more. The other devil is taxes. Ugh, taxes just suck. Can we all just give like a, like taxes just suck. They get us left, right, and center. They is it from your business to your personal, and we're always, when we're looking at these calculators and deal analyzers, the taxes are really what kill. And it's knowing the tax code, because I'm sure all of you read the tax code, you know, just in your spare time, you know, to be able to get ahead, you know, but that's why we're part of groups like this, you know, so that we can lean on each other's expertise to create the best plan for not just you, but your family, your business today and tomorrow. And so diversification is kind of the third leg of the stool here, you know, because when it comes to retirement accounts, and you can look at your own or think of those investors that you work with. So I know a lot of you raise capital on this call or work with other people's money or have investment offers as well. You know, diversification is the key. When most are in the stock market, okay, there's no control there. You know, you just went over like the booms and the busts. You know, you got to start off with the win, and the win doesn't have to be like, you know, jackpot win. It has to be consistent and predictable. But the key here in diversification is the tangibility. You know, my personal thought was they teach us backwards. You know, you go to school, you get a job, you throw money in this 401k thing that your employer offered at one point, and you buy, hold, hope, and pray it's there at the end of the day. And it's usually someone like an HR that's telling you what to put where because they're qualified, right? No offense to anybody in HR, but it's a financial thing, right? So now you're in something where you're putting all your eggs away and it's up and down, up and down, up and down, where really we should be doing that in reverse. You should be starting off with the tangible assets first that provide that consistent, predictable income. And this is true inside and outside retirement accounts. And then once you have that, that covers your needs number to live, you know, and maybe your wants number for your lifestyle, now you have what they call in the financial world as risk tolerance. Now you can take on a little bit more risk for those bigger swings in the booms and the bust. You know, so it's backwards as far as like how we're taught. Because the key here is it's not about what you make, but how much you keep. And I love that Robert Kiyosaki added the last part here. It's how hard your money works for you and how many of your generations can keep it. Like that is the big picture thinking, guys. So I want everyone on here to, grab your pen and paper because I'm going to have you start jotting some stuff down as far as your own inventory, as far as what resources you're working with and what you could be working with. Okay. And before I get to that, I want to teach you guys a word that I love, and everybody's going to say it out loud with me. Okay. So this favorite word of the dictionary, and it will be yours too, because it has tax implications, is Roth. Roth. And why am I stressing Roth and doing a Webster's dictionary explanation here? Is because taxes, guys. When you have taxes or a tax deferred account, you're just kicking the tax can down the road. You got that? So at 59 and a half, you take that money out and then you're going to pay Uncle Sam. And at 73, he's going to force you to take it out. Guess what does not ever force you to take it out? A Roth. Okay. When you think Roth, you pay the tax on the seed and not the crop. I want you to all say this out loud in your offices, and I don't care how cheesy, think tax free. And yes, you got to say it right that. I know it's a stupid mnemonic device, but if you are really following me and going tax free, y'all are smiling and I just can't see you. Okay. But the point here is know your buckets, know your tax diversification. It's a teeter-totter, guys. So the more that you can keep on the tax-free side of the teeter-totter, that's where you want the big kids sitting at the end of the day. All right. Because it's, like I said, paying the tax on the seed and not the crop, is great, right? You pay the tax on the little amount, but how would you like to not pay taxes at all? Oh, there is a way. I know I need sound effects. I'm not good at them myself, but here I'm going to give you guys, because I wanted to drop some high level nuggets on here today, because everybody's situation is different, but this is a key one. So within self-directed IRAs, 401ks, and I'll go over all of those that you can self-direct. There's one that always sticks out. It's called the Roth Solo 401k. And I don't want to get into all of the nitty gritty here, but there's one key concept I want you guys to pull away from this. So let me walk you through this beautiful little flow chart. So most of you on here are either in one of, I would say probably three categories. You're in W-2 world, and you may have a, side hustle entity. You've got additional streams of income, right? That's where we're all going. Or you're full-time entrepreneur in the quadrant, and you have multiple businesses in different streams of income. Okay. And some are one or the other or hybrid. Like those are the three lanes. Okay. And that's typical for who we see for clients that are self-directing. This account is what I call the triple threat, because one, if you have a company with no W-2s, just you and your spouse, you can W-2 yourself. That's A-okay. All right. But in a 401k, this is where it's never explained. There's only two hats. You're the employer or the employee. But when it's just you, you're both. All right. So as the employer, it's not about what you make, it's what you keep. Right. So IRAs, fantastic, guys. Heartbeat, earned income, social security number, you can have one of those bad boys. But as a business, putting away, and they just upped it this year, 7,000 to 8,000 a year is not going to move your tax bracket. If you can put away up to 46,000 a year, that's going to help move your tax needle, right? The big end key is you put that money in there and you can invest it just like you are today in tangible assets. Okay. Now the other piece, my favorite word, Roth tax free. Okay. Here you can put in, and they upped it this year too, 23K if you're under 50 and 30,500 if you're over. Okay. There's no income limit here, just FYI. I hear this all the time, even from some of my advanced individuals that are like, my CPA says I make too much money. No one makes too much money to have a Roth. As of 2010, you guys, everyone can have a Roth IRA. And I'm going to show you how. But going back to this plan, okay, so I just gave you a way to, save over 60, 70 grand a year where you're paying yourself and not Uncle Sam. But here's the big benefits is it goes to that diversification in your investment strategy, right? Yes, you can put more away. Okay. You have tax diversification in one plan, which is key to success. For those of you that are nowhere near retirement and you have a 401k, guess what? A 401k you can borrow against 50% or 50,000. And I get this one a lot, guys. Well, Amanda's retirement account stuff's great, but I need more money in my pocket today. Great. You can do this plan. Sorry, guys, I can't mute this, but somebody's calling in for a retirement account. So that is the restriction-free loan where you pay yourself back interest. So we're always keeping streams of capital, cheap capital to the most expensive. This is the number one slot. If you're married, you both can do a loan. That's $100K that you would have access to if you had $100K at least in your accounts. So that's huge right there. No UBIT tax. And some of you are probably looking at that like, what does that mean? Leveraging. We all love leveraging on this call, right? OPM. You can leverage a retirement account. So whether it's for one asset or in a large deal that has a non-recourse loan on the back end, do you think the IRS is so nice to give you those borrowed funds without charging you something? They're not. So when you do that in an IRA, you trigger this UBIT tax, which can be up to like 37%. Ugh. How do you avoid it? You do it in a qualified plan. Ta-da! So the other thing I wanted to note here on a qualified plan that was new as of last year is, and Tim was touching on this, was fees. Know what you are paying for your vehicles and your investments. With a solo 401k, and there's other small business plans that qualify too, they passed something called the Secure Act 2.0 last year, and you get a tax credit for any small business plan. So it literally ends up being a wash. Awesome. So I'm going to bring this back to our Roth. This is something called, it's a technical term. It's called a Roth conversion. And I don't mean to get too techie, but how many of you have heard of the mega backdoor Roth? Yes? I'm seeing some of the heads I can see are bobbing. Okay. So this is when you move from tax deferred to tax free. Okay. But when you do that, you got to pay Uncle Scam in the middle. But everyone on this call, you're doing real estate. You're doing passive real estate that give you things like depreciation, cost segregation, and your real estate professional status, right? So what does that allow you to do? That allows you to win the game. So when you do this movement right here, which you can do incrementally year after year, you have just exercised what is called the mega backdoor Roth without paying a dime in taxes. The trick is you use the tax code, and I know you have awesome CPAs at your fingertips, is using that depreciation, deduction, cost seg, et cetera, to cancel out the taxes that are incurred. Hence, mega backdoor Roth. And yes, your years ebb and flow. So do you do this all at once? No, not typically. But could you? Yes. Can you do it incrementally over time? Yes. And I want to tell you guys this too, because when I have these conversations one-on-one, a lot of you think like this has to take a long time to do. So I'm going to give you an example. I have a good doctor that I work with, also does real estate, started in single, went up to multi. Okay, kind of the natural progression, right? He was a real estate professional status as well. He was able, I met him in 19. Okay, so he really started doing this stuff within his retirement account in 20. So that was what, 4 years ago now. He was able to do a over $500,000 conversion last year and did not pay a dime in taxes. 4 years, guys. So it doesn't take forever. And I want to stress that for these, because when we're talking mega, we are talking size, and size does matter in a lot of things in life, right? But no, in retirement accounts, you guys, retirement accounts, the size does matter, especially if you're raising capital, right? Within these accounts, and there's some crazy stats as far as like the amounts that are in retirement accounts and who has what, where, and when. Okay. But I'll touch on that in a second. What I want to drive home here is OPM, other people's money or other people's IRAs. And Tim, you always do an excellent job at highlighting this, as do others that are on this call. I see your head, Jathan. There's a lot of money here in retirement accounts. All right. The recent stat as of end of last year, 36.7 trillion. Okay. With a T, trillion. Okay. So these are in things like IRAs, 401ks, QRPs, all that jazz. But the point is, if you have a model where you are raising capital, guess what? The money is all around you. One. Two, it is in retirement accounts. Three, Tim, you hit on this. Why don't people know that they can do this? Because their advisors are not telling them. And why? Because they're not making money on it. And I don't want to paint a negative light to all advisors, because I have some fee-based advisors. They're independent. They do a rock star job at truly diversifying their clients' portfolio, but not your average. Okay. If you're talking to someone and they say, oh, I've got an account here at, a Fidelity or a Schwab, and I don't mean to call it big banks by name, but they will advertise they have a self-directed option. And that just means you pick your stocks, bonds, mutual funds yourself. And that's not true self-direction. True self-direction is you can do real estate, you can do private placements, you can do private lending, flips, all of that. Okay. So where do we find this money? I want to give you guys a highlight reel. Okay. And this is one I encourage you to screenshot. All right. So when you are talking to folks, or even if you're thinking of yourself, I want you to take out your pen and a notepad right here. Because if you hear, or if you have a team that is doing the qualifying for your potential investors, these are the hot ones I want you to listen for. If you hear rollover IRA, that means they had a once upon a time 401k, they can move that. Roth traditional, they can move that. SEP simple, they can move that. Some of the ones that you may not be, unless you're in this arena, familiar with are TSPs. Those are thrift savings plans. Thank you for your service. If you know what those are government version of 401ks. 403Bs. We see this a lot in the education as well as the medical field. Keoghs, you don't see too much anymore. ESOPs, profit sharing plans, PERS accounts. So every state has a different education system, retirement system. Ohio is OPERS, California is CalPERS. If you're no longer teaching, you can move that sucker. It is not stuck there. And they do give you the impression that it is. Drop plans, defined benefits, health savings accounts. I cannot stress enough. You put money in there. If you have a high deductible health plan, that's the precursor. Okay. You can do, it's over $8,000 this year for a family. You get the deduction and it grows tax what? Free forever. Okay. That's huge. You're talking about the pitfalls and, the risk is what you cannot see. A lot of times for folks, that is your health, especially the closer we get to retirement. Education accounts. I mean, I know a lot of us on here have kids, that's huge. Are you paying your kids? Do your kids have Roth IRAs, education accounts? These are all types of accounts that you can self-direct and that I want to hit on, because it's not just a one account does you justice. It's just like when you're setting up like entity structures, you got to have multiple streams or buckets to put these funds in. That's the name of the game. So I'm going to walk some of you through, I know have never done a actual deal, and that's where the technical question comes in. Think of these as just like a separate operating account, guys. That's it. So if you have those funds, you can move them over here to a self-directed account. And that's what I do. My team does all that heavy lifting. And then you're ready to do a deal, which we have all around this call right now. Okay. So an example would be you open and fund the account. That's step one. Step two, it's the same paperwork that you do for deals outside your retirement account. The secret sauce is the titling. Like I said, it's like a separate operating account. So if Tim has a Roth IRA, it's not Tim's name I'm putting on the note, mortgage, or private placement docs. I'm putting specialized trust company custodian for benefit of Tim's IRA. Okay, that is the secret sauce. So simple, right? And then we process the funds. They do the same thing that they do every time. Goes to title, goes to the investment sponsor. They do their thing. Returns are made. This is the fun part. Where do your returns go? Right back into your account, 100% tax sheltered. So you log into an account here, guys. You're not seeing all of the colorful charts and graphs, and you don't honestly really know what you're looking at or what is my return. It reads just like an account ledger, right? Like your checking account. Here's my asset, here's my cash flow, that's your return. Super simplified. And that's the key is to keep it simple. I was reading up on some stats, just with year end, et cetera. This floored me. I think this was a Fidelity stat that the average growth was 4.9% on a 5-year average. Ask yourself, and this has to be like after fees and all that jazz. So all of this comes into the mix. Is that hedging inflation, or are you just going broke slower? That's the true math. Okay. And then going back to my initial quote, it's not what you make, it's what you keep, yes, but it's what you keep generationally. When we're thinking instead of rich, we're thinking wealthy, we're thinking beyond ourselves, we're thinking for our kids. And the adverse, you're thinking of your parents, and how that will work coming to you and going to your children. It is a mindset shift that has to happen, and the conversations need to be had. All right. So I'm going to give you guys just like an example of what that looks like when you're talking about different buckets, and think of yourself, write down yourself, your family members, and where do you have your buckets for each family member? So let's say you have mom and dad have a 401k. All right, there's two. You also have personal accounts for mom and dad, whether they be Roth or traditional. And you have a couple kiddos, regardless of their age. I really hope, and I'll leave this to the CPA professionals of the room, that you are paying them something because it will help reduce your tax bill, but it will also allow you to save a Roth for them. And a Roth is tax-free forever. If your kids are under 18, or even if they're 20, play with the compounding interest calculator. And to your point that you made, Tim, you want, and if you have an average return that is consistent over time, and quite honestly, they have so much time that the account could do pretty crappy, and they'll be millionaires because of compounding interest. Again, it's just math. But this is where I like to simplify it. When you have all these different buckets, some people can be going like, how do we solve complex issues? Deal structure, right? It's get creative. What can you do? What do we do normally when you have multiple people that want to go in on a deal? You partner, right? Same thing here. You can partner all of these together on an LLC where it's all going tax sheltered. And now you can do your deals. So obviously I'm talking deals in real estate, right? So, lending, private placements, commercial, et cetera, to where everybody is benefiting from what is happening. Okay. It's not just for you and your retirement. You're taking care of the generations. And like I said, this can go up and down on the family tree that you can structure this however you want. I've seen clients do it like one for the parents, one for the kids, and then they have a combined one. You can get as, large or small, but the key is starting. The other thing that I love that you pointed out was the fees. And like I said, I get that question all the time. It's always the trepidation. Who are your fees? Well, what do you pay on your account now? No one ever knows, ever. I never get an answer for this, ever. If they're self-directed, even they don't really know. Where self-directed accounts, you guys, as far as fees are concerned, they're flat and upfront. So you know exactly what you pay. Like I can speak for our platform. Like we do something called a family plan where it's so much education we build into it. When you have education under your business or personal, can you deduct that? Yes, you can. I'm not a CPA, but yes, like they did away with IRA deductions back in 18. And you can't write those fees off. We just got a win back last year for small business plans. So to your point, it doesn't break the bank to utilize these vehicles. It's just having that initial conversation and seeing when it makes sense. That's it, based on where you're at. So I'll throw my info and stuff in here, and I can't wait to be in New Orleans. I hope we'll see all of you that are on this call there. So love to chat in person. You probably tell I am a chatty Cathy, but my gift is time. If you're curious or you want a checkup on, hey, this is what I've done. Is there anything I could be doing differently? Let's hop on a call. That's a link to my calendar. I have my little Vanna. Oh, I did backwards here. That is always my gift because you guys are dedicating time out of your day on a Friday to better yourselves. This is how we give back to the family, right? And I'll do my legacy wealth cheers right there. I love this little family guy though. I have to say, Tim, that was good. Or Annalise, whoever was the brainchild here, good job. But it's your money, it's your future. I want you doing it your way. Like that's our big, value add to the group. So I want to be respectful of time and not go over and bring this open to any Q&A that anybody has.
All right. They even had me muted, so I couldn't talk. So they just unmuted me. All right. First of all, super, super helpful. Thank you so much. And I hope. Well, here's the thing. Anybody who's on this, now you don't have an excuse, right? Now you know that this exists. Now you know that there's people with accounts. There's people that don't even know that they have access to these kinds of these funds. Where if you ask them, hey, do you have an old 401k or an old IRA or an old retirement account from some other employer? That is an easy conversation to have and then help them roll it in, or any sort of Roth IRA. A lot of people, those are probably the two big ones that I found, is they have either a 401k or an IRA from a previous employer, or they have their own Roth that can easily be converted. Here's another thing I found. The financial advisors always poo-poo it, right? Well, that's a bad idea. Just do this. They're looking out for their own best interest, right? Yep. You should be looking out for your own best interest. The specialized IRA does not tell you what to invest in. This is all up to you, and you direct it. It's self-directed, not directed by an accountant, not directed by an advisor, not directed by a custodian. It's directed by you. So you, one, know that this exists, first of all. Secondly, look at the community, guys. Like, look at the people. There's 30, 40 of us here. There's hundreds, if not, we'll have over 1,000 people who watch on social media. Like, we're in the real estate world. They're like, you can easily knock on some doors, tap somebody on the shoulder and say, hey, is this something? Would you take money this way? And we've done it through, I don't know, dozens, if not hundreds of our investors have invested through self-directed retirement accounts with us. And so now you know. So now you don't have an excuse, right? And now you have a tool in your arsenal that has $37 trillion out there that you have access to. So the other thing, yeah, it's wild. And the other thing that you mentioned is the self-directed family LLC. So essentially all you do is, like, I have a Roth for each of my kids, right? I pay them because I put them on a whole bunch of marketing stuff. I put them on, like, I pay them as models, right? And they're on a whole bunch of marketing. They're on Facebooks. They're on do a bunch of stuff for the kids' books and all these other things, right? Social media, YouTube videos, all that. So I pay them in the Roth every single year. I pay them enough to contribute to their Roth, and then they contribute it. And each of my kids has what 15 grand. I don't know. I started doing it 2 years ago, so they each have like around 15 grand in their Roths. Then I have a six-figure retirement account, which, by the way, it was a 401k originally. Um, it was like a solo 401k or something. I started having employees and changed some things up, but it was a tax deferred account. Think about this, guys. Do you guys think that so tax deferred means you get the write off this year, but you pay taxes in the future, right? Whenever you take that money out. Do you think that the tax rate is lower today or it's going to be lower in the future, right? And do you think you're going to make more money today or make more money in the future? So in my mind, you probably want to pay taxes and have a Roth component and be contributing to the Roth as opposed to something that's tax deferred. I'd rather contribute today at a lower tax rate at lower income than what my net worth and what my wealth will be in the future. So that's a quick aside. Um, and so one of the things that I did is I had bought a bunch of apartment buildings. I had a bunch of depreciation. It was tax deferred in a traditional 401k, but I had a net loss on my tax return that year. So I took my 401k that was tax deferred, rolled it over into a Roth. So that way I paid taxes on what I made this year, or it wasn't this year, but it was some on that what I made that year, which was nothing. So I took all that money and rolled it right back into a Roth component, and I never had to pay taxes on it. So something to consider if you are real estate or you have a bunch of losses or depreciation in your business or whatever. Um, and then my wife, right, has a six-figure one. So we actually haven't done this yet, but it makes it so much simpler because before I was thinking, this one has to invest, this one has to invest, this one has to invest. But you can just create one LLC. Everybody invests in that LLC, and that one LLC then invests, and then it just kind of disperses that way. That's so much simpler.
Yeah,
Good,
absolutely.
good stuff.
Absolutely. And, for those of you that are like raising capital, on this call, like when you talk to folks, and I find this a lot of times is, you're gunning for the cash, right? And you don't bring up the retirement account stuff because it's like, oh, no, talk about it. You don't have to. Like that's where, leave the technical stuff to me. Just say, hey, I've got a team member, they're rock stars, 2 weeks or less, funds will be there. You're ready to go. The key is just knowing that you can, because if you are just learning this or you've only been exposed to it for a couple of years, think of your sphere. Like I know I had everyone writing stuff down. Write down like 5 to 10 names of people that are in your circle and just bring it up in conversation of, hey, did you know? And I guarantee you're going to find money out of it. Like it is as simple as that because they are listening to that advisor that is telling them to, weather the storm. It's cyclical. It's the long game.
I,
I mean, they're
I,
all terms.
I mean, you guys have heard about the book, The Who, Not the How, right? And Amanda is the who, not the how, right? If you notice, I didn't explain self-directed retirement accounts to you. I found the who, who's an expert, to come and convey that knowledge to you. However, I get a lot of the thanks, Tim. This is amazing, so much insight, and all these nice comments, and I appreciate that. I didn't even bring the value. I found the person to bring the value. So guess what? Amanda is an employee who works for you that you never have to pay. And if you want to put her on the phone with some of your investors, or you want to put her on a podcast in front of your circle of influence, you're going to get a lot of credit, right, for bringing that much value by just letting her do her thing where you don't have to become the expert on it. She sets them up. She's able to square it all away. And then great. Now she educated them. She helped them move their money into a self-directed account. Can, lets you know whenever it's ready. And then all of a sudden you can go and invest. Here's the other beautiful thing. And I want to get to the comments and all the questions in a moment. There's some very good questions in the chat box. But like I raise money for syndications through self-directed retirement accounts, and then other people bring cash. When I raise capital, a self-directed retirement account, it can't receive depreciation. And so it allows me to then accelerate or give more depreciation and disproportionately allocate it to other people who maybe didn't, or maybe it goes to the general partner. So if you're raising money on a deal and you bought a $5 million deal and all the down payment funds came from retirement accounts, it does not adversely affect that retirement account at all because the government would just light that depreciation on fire. So you can then disproportionately allocate the depreciation entirely to you as the general partner, and you can have heavier depreciation in the certain deals that you do. It's a wildly powerful tool when you start understanding the dynamics of it. So Brian Fast, a great friend and business partner, investor of ours, has a question over here. Since depreciation can work on investments for non-real estate professionals, so he's saying depreciation can work on investments for non-real estate professionals. Would converting the 401k to a Roth, utilizing the depreciation, work for a non-real estate professional? Does that make sense?
Yeah, it can. It depends on how they're doing your taxes. It is key. Like, are you set S corp, flow through, etc. But absolutely, it can, especially if you do it on a personal versus a business level. That has something to do with it as well.
Yeah, Brian, shoot me a text and I'll connect you with Amanda after this. You guys hop on a call with your CPA and just make sure it's all aligned, and you guys will be all set. Got some good feedback. Thank you, Amanda. Great information. Thank you. All right. Can you do a Roth checkbook account with Specialized? What are your thoughts on checkbook accounts?
Yeah, you guys win. I love this question because it's like, oh, do you do checkbook IRAs as if they're like a unicorn product? That's just deal structure. So when I was talking like that LLC, whether you have an account, IRA, 401k, or a group of accounts that has an LLC, the LLC, you get this fancy thing called an EIN. You can take that to your local bank and open a business checking account that is all tax sheltered. That's checkbook control. So where I
is that
see
something you guys do, or somebody that they would do that on their own?
The LLC is a third party. Like, we stay in our lane. We are all, self-directed accounts, et cetera. So it's just set up third party. It just needs to be owned by the retirement account. The titling on the op agreement needs to read specialized trust company custodian.
And then there's just a manager, and I could manage my own account, right?
Yep.
So it's the operating agreement will state, hey, here's whether it's just one account or it's a family LLC. It'll say, hey, this percentage based on this amount of money that probably goes in. Could it be owned disproportionately or no?
Yeah, it can. The percentage,
if it's an LLC,
it's determined by the amount of funds that they're putting in is what determines the ownership. It's just the ratio.
Right. I guess, for instance, I have an LLC, and maybe this is a better question for Fatty, but if I have an LLC, let's say I got 3 kids and my wife, and the kids each put $10,000 in, and then my wife and I each put, I don't know, $35,000 in, right? It's $100,000 in the account. So I would own 35. If you just go by contributions, 35%, each of the kids owns 10%. My wife owns 35%. I mean, an LLC, you can disproportionately allocate profits and depreciation, those kinds of things, but you couldn't do it if it was owned in this capacity, right?
No, correct.
Because it seems like too good of a swindle.
You're totally getting in the red zone there, Tim.
All the money, owns 1%, and it all goes into this other account and starts funding. Yeah, I could see how they wouldn't like that. So that makes a lot of sense. How does your product differ from an account with EQRP? I'm not familiar with what that is.
Gotcha. No, I am. So EQRP is kind of what I call more of like the DIYers of a 401k. And a lot of times they'll name you the TPA of your 401k plan. So I'll give you an example where that has bit some clients in the butt, and I've had to do some fixing and unwinding. A TPA, so you guys know, is a third-party administrator. And it's not a CPA, a TPA. And they make sure qualified plans stay compliant with not just the IRS, but ERISA, which is Department of Labor. Okay. In the past couple years, we've not only had a reinstatement year, which most don't know what that means, but it means they have to redo all of the plan documents for all of the 401ks every so many years. The CARES Act affected 401ks a ton. If you are not keeping up with this, you are in non-compliance. If your tax sheltered nest egg is in non-compliance, will that fare well for you when you go against the IRS? It will not. So it comes back to, like, do you represent yourself in the own court of law? Do you do your own taxes? Those answers are no and no, which I'm loving all of my head nods. Thank you guys. That's where, you have grown to where you need to have more of a team to do that for you. Like that's the difference.
Mm-hmm.
In our world, just like everything, there's the DIYers. There, where, hey, a couple $100, you can do this. And it's good luck, Chuck. You're on your own. You will never talk to another soul.
Yeah, I mean, it's not worth the risk, right? Like you're going to do all these deals for tax savings and tax advantages and tax deferrals or whatever, and then like if you write in one thing the wrong way and it's not double checked by a higher authority that knows what they're doing and can make sure all the T's are crossed, I's are dotted, then it opens up that entire account for taxation, right? Like you don't want to do that. So I would
Correct.
utilize
Transaction.
them the same way you utilize a CPA, an attorney, a mortgage broker, and it's somebody who works on a fee base. So they just want to make sure that you do it right, and it stays that way because they're going to keep on doing business with you. Then you're going to
Yeah.
keep on doing business with them.
Yeah. Right butts in the right seats.
Jeff asks if I converted my retirement accounts to self-directed to buy real estate. He said the funds would be in my name, but I buy real estate using my LLC. How does that work? And I think what he's asking is, Jeff, your funds are not technically in your name. Your funds like create their own account number with specialized IRA, right? So or specialized trust, and so it'll say the funding will come from the titling of specialized trust services for benefit of Jeff Liu and account number XYZ or whatever it is. And then that will invest into your LLC and you still buy it in the LLC.
I want to clarify when you're investing in that LLC, it has to be a brand new LLC, Jeff, owned by the retirement account. You cannot take your retirement funds and invest in a single member LLC that you already own. It's called self-dealing. So
yeah.
You want to make sure you keep it in a lane in and of its own. It'll operate the same way. That's why I always say it pretty much mirrors what you're doing.
And I think there's a couple of details, Jeff, that we need to talk about because like can he then bring his own personal funds with 401k funds in order to buy a house?
Yeah. So it's
Okay.
partnering via undivided interest. So I always call this the how do I have my cake and eat it too?
Mm-hmm.
So like Jeff, you look young, man. So, so you're nowhere near 59 and a half. This retirement stuff's great, but I've got money here, money here. I want part of these profits in my pocket. You just partner together via undivided interest, whatever percentage, but say 50-50. That means half the profits will go back to you, half go back to the retirement account. If you have expenses, guess what? They're split 50-50.
Yep.
Same thing. So there's no commingling happening. So that's what
Mm-hmm.
makes it kosher.
Yeah. And what I've found with these self-directed accounts is like everybody's scenario is a little bit different, or it helps to understand the global picture and then get on the phone with like Amanda or somebody else at Specialized and just like talk through your specific situation. So that way you have 100% understanding of what you can do, what you can't do, or what you shouldn't do. And the best way to operate it. So again, utilize them as a resource. They're fantastic. And by the way, I get nothing for sending you guys to Specialized Trust. They're just great friends. We have our accounts with them. They're absolute rock stars, and the only trust company that I've invited into Legacy Family to be part of our community because I love and trust and respect them so much. So we will put Amanda's contact information over here. If anybody has questions, reach out to her. And this is something that you should be doing for yourself, and you should be talking to everybody that you talk money and finance and dollars and decimals with. It should be part of the conversation, right? I don't have any cash. I'm strapped. Well, what about the retirement accounts, right? And the beauty of investing, what I found is two things allow you to get into better deals. Is one is lower interest rate money, and retirement accounts. Well, one is lower interest rate money, and two is longer term money. And if you got one or the other or both, you can buy better deals that way, right? And the beauty of retirement accounts is they want a safer return. So you don't have to give them the 25%, 22%, whatever kinds of returns that some people are looking for. A good fixed, right? Educate them on some of those slides that I shared with you earlier. A good fixed 7, 8, 9% compounded over time is far better than what the stock market can perform at. And they're not looking for the money back in 3 years because they need to cycle it or anything like that. They're okay with a longer time horizon. So especially for the syndicators out there, it's a great resource to say, hey, it's 5 year money or it's 10 year money, and then they don't have to worry about doing the transactions and doing the paperwork and all that stuff again. They'd rather just set it and forget it. And you have a longer time horizon now on that money. So now it allows the property to appreciate, rents to bump up, and you to pay down principal on the loan. So that way you can be sitting on a little bit more equity in 5, 7, or 10 years from now, rather than being concerned about what the market, what interest rates, and what things are going to look like in the next 36 months and when you have to cycle their money out. So it's a great resource, and understanding who has access to funds in their retirement accounts versus who's got cash, you can kind of um, uh, uh, take orders from what they're looking for and say, hey, this would be the right opportunity for you, or this one might be a quicker turnaround for the cash people, and then this is a better turnaround, or this is a better investment for your long-term stuff. And you can almost help them direct their funds based on the opportunities that you have available. So it's
Yep.
good stuff. Amanda, thank you so much for being here. Thank you for all the wisdom and insight, and excited to see you in New Orleans next month.
Yes, right back at you. Thank you. Appreciate y'all. Hugs.
Fatty Bumitri,
Yes,
bringing you
sir.
up, brother. And Fatty, and I talked to Fatty. He's got some good, simple slides, and I love what he's going to share is like the levels of depth to questions that you should be asking as you vet deals, as you vet operators, and a lot of the freshman year, sophomore year, junior year, senior year types of questions. And most people don't get past sophomore year. Most people stop at 101 or 202 level, and I think it's important, and especially for somebody like Fatty, who he and I have raised over $120 million from individual investors, never any institutional funds. I'm talking mom and pop entrepreneurs like you and me, family members, 401k, and 50,000, 100,000 to a couple $1 million increments. And help people allocate funds into different deals and stuff with us. So he knows who asks questions, what the good questions are, and he's sharing all of those with you. So get your camera out, take some notes, and we're going to open it up for Q&A after Fatty's session, and then we'll bring it home. Take it away, brother.
Yep. So I'll try to breeze through this pretty quickly. As Tim said, we're going to kind of go from beginner level to intermediate all the way up to what I consider to be a little bit more advanced, right? So starting with the 101 level, for the beginners, there's really two different types of investments. You've got your equity investments, you've got your debt investments. A debt investment is usually going to be a loan, right? That's the easy way to think about it. It's going to be paid an interest rate of some sort. It's going to be formalized through a promissory note and sometimes secured by collateral, including a mortgage, UCC filings, financing statements, things along those lines, right? And the payments on this loan are generally going to be required no matter how the deal itself is performing. Obviously, a loan is still a contract, and so you can essentially negotiate anything that you want between the lender and the borrower. But the general premise is, hey, I don't care if you're making money. I don't care if you're losing money. You owe me money as a debt. You've got to pay me that money. On the other end of the spectrum, though, is the equity type of investment. So this is going to be ownership in the company itself. It's going to be paid out through distributions as opposed to interest rate, the way that a debt is. It's going to be formalized through the operating agreement of the company, maybe issuing shares or units in the LLC, either way. And generally, you're going to subscribe to it through a subscription agreement of some sort. And generally, the payments are only going to be required if the company itself is making money, right? So if the company is losing money, you may go a year, 2 years, 5 years, however long, without seeing any return on that investment, as opposed to a debt where, again, they don't care whether you're making money or not. The debt lender needs to be paid every month, every quarter, whatever it is. And then, finally, the equity side of the equation gets to see upside, from the company. So if the company gets sold for a lot more money than it was worth when the person invested in it, right? So you as an investor, if you invest in a company, you get that upside. So the debt, you don't get that upside. You get whatever the fixed rate is, or even if it's a variable rate, you get whatever the interest rate is based on the calculation that you've predetermined. Otherwise, the equity side of the equation actually has the possibility of making no money, but the possibility of making significantly more money than potentially a debt could have made. And then obviously on the equity side, there's a lot of different structure thoughts to go into whether there's going to be a preferred return, hurdles, waterfalls, things along those lines. So this is the very basic beginner level of what you need to be thinking about when you're making an investment. The next level begins the vetting process. So the 201 level, you start to think about who is the operator? What does the property look like? What is the location in the area? You're going to want to look a little bit deeper into each one of these things. So for the property, you're going to want to find out what class of property it is, what kind of condition it's in, how much work it needs, things along those lines. For the location in the area, you're going to want to know, is the population going up? Is it going down? If it is going down, or even if it's going up, are there new construction projects that make this more enticing or potentially less enticing? For instance, if there's a brand new facility being built down the street and it's going to bring 5,000 new jobs to the area, that's probably going to make the building more enticing and the area more enticing. But if there's a new construction going down the street and it's going to bring 5,000 additional multifamily units, it's probably going to make your investment less enticing. And obviously the last thing you're going to want to look at as far as the location and the area is the rents in the area, and specifically compared to the rents of the building that you're looking to purchase. From there, you're going to want to ask the operator what qualifies them to operate this deal. Why did they choose this particular deal? What is it about the deal that they like? What are some of the things about the deal that they don't like and they wish they could change? What's the value proposition? What are they going to do to increase the value of this particular deal? And probably the most important question, and what I find most people care the most about, is how is my investment protected? How do you make sure I don't lose my initial investment? So those are some of the things you're going to want to ask the operator that you're looking at. And then questions to ask yourself, and this is all still part of that 201 level vetting process, right? Do I trust this person, the operator, with my money? Do I believe that they're not going to steal my money, right? That's the first level. The second level is, do I trust them from the perspective of, do I believe that they have the capability to perform, the capability to do what they say they're going to do? So whether or not I trust them to steal or not steal my money, do I trust them to be able to perform, right? Do I like the value proposition? Do I, having already vetted the property in the area, they're saying they're going to be able to raise the rents by $500 per unit. Do I like that proposition, or do I see from my own vetting that that's a little bit unreasonable because they're already at the high end of the market, all right? And the asset class that they're talking about doesn't warrant that price. And maybe they're not looking to do a whole lot of value add, or maybe they're looking to do a ton, but at the end of their value add process, where does it lie as far as what the rents should be, right? So again, you're looking at what is their value add proposition? Why do they think that this is worth investing in? And do I agree with them? And then finally, do I trust that they're going to return my investment? I asked them specifically, I asked the operator specifically, how is my investment protected? Now, do I trust that it actually really is protected based on what they said? From there, you graduated into the 301 level, right? And now we're talking about the structure of the deal itself. How was the deal put together? What does it look like? How long will my money be held by this operator? How long will it be in the deal? What are the preferred returns? What are the waterfalls? What are the hurdles? And if you don't know what these terms mean, this is where the 300 level comes in, right? A preferred return essentially means that the investor is entitled to some kind of return. Let's say the most common return is between a 6 and an 8% return. but the investor is entitled to that return before all other distributions are made on an equitable basis. So if I'm a 20% owner in the deal, I'm not getting my 20% distribution until the investors get their preferred return. And then the investors, myself, everybody gets our equitable portion. So I would get my 20%. And waterfalls and hurdles are essentially, think of them as, if something happens, then something else happens, right? If we hit a certain percentage return to the investors, then everything above that gets split maybe differently than the equitable portion. So maybe I get I get to 15% return on my 20% equity, and then I don't get 20% of everything above that anymore. Now I get 15, or I get 10, or I get 5, or I get 50. So you're changing what percentage somebody gets after you get to a certain return metric. What kind of fees are the operators charging? Are they charging an acquisition fee? Are they charging an asset management fee? Is there a disposition fee? Is there a capital management fee, right? There's an unlimited number of fees that people can come up with, and they can charge any fees that they want as long as they disclose them. The question is, what fees are they charging, and what is the priority of payment? I'll give you a hint. Almost every syndication outfit that I've ever seen has a priority of payment that looks like this, right? First, it goes to the debts of the company. So you're talking about the mortgage, you're talking about any liens positions, you're talking about the operating expenses, paying off the aged payables, things along those lines. Then it goes to the operating partners for their asset management fee. Then it goes to the investors for their preferred return. Then it goes to the equitable split. And then it goes into any hurdles and waterfalls, right? So that's usually the progression that you see. Very rarely do you see either operators that don't take that asset management fee the way we generally do not take that asset management fee, for instance. But the way that most people do, they could take it differently, right? So perhaps the asset management fee in a particular case sits behind the preferred return, but in 99% of cases that I've ever seen, the asset management fee gets paid first, which means the syndicator gets paid before the investors do. Tim and I were not a fan of that, so we actually flipped that on its head. But you've got to know who gets paid first. What kind of updates and communications should you expect? Are they going to send you an update every month, every quarter, once a year? And then what are those updates going to look like? What kind of information am I going to get? When do my returns get paid out? Is it going to be monthly? Is it going to be quarterly? Is there a period of 12 months where they expect not to be able to pay anything, and then they start to pay out? And then one of the most important things you can ask is, hey, if the deal needs more money, who gets diluted, right? Do the investors get diluted to bring in more investors, or do the operators get diluted? And I'll give you a hint here too. 99% of the time, the answer is that the investors are going to get diluted. Very few outfits out there will dilute themselves if they miss the mark on how much money was needed. Now we're graduating into the 401 level, and we're talking about tax strategies. And this is for the people that have a higher income, have a lot of taxation that they're trying to offset in a given year, and you want to ask your operator whether they're doing a cost segregation study. And essentially what a cost segregation study is you bring in specialists that will literally look at everything that you're buying. So you are looking at it as one big apartment. These specialists will come in and look at it as various categories: 5-year, 7-year, 15-year, and 27.5-year property. So the land can't be depreciated at all. The building will depreciate at 27.5 years. And if you don't do a cost segregation study, then your entire purchase price gets depreciated over 27.5 years. But if you do a cost segregation study, things like the toilets, the cabinets, the flooring, the fixtures, the drapes, those are all going to fall under 15-year or less. And based on the way that the Internal Revenue Code is structured right now, you will actually get to depreciate those things faster if you choose to. And so the cost segregation study actually allows a bunch of depreciation in year one. And you could, and one of the things you should be asking your operator, not only are you doing a cost segregation study, but what does the first year depreciation look like? And what does the depreciation look like after the first year? You also need to familiarize yourself with recapture and what recapture is and how much recapture you're expecting, right? So if you're depreciating a whole bunch of 15-year and 10-year, 7-year, 5-year property in the first year, but then you're selling at year 2, you probably haven't depreciated those assets enough. They're probably still worth money. So even though you've taken the depreciation, the actual loss of value has not been realized. It hasn't actually happened. And so you'll actually have to pay taxes to recapture some of that depreciation if you haven't held the property long enough. You should be asking yourself and the operator, how long are we planning on holding the property, not only because you need to know how long your money will be in, but also because you want to make sure that you're getting the benefit of long-term capital gains as opposed to ordinary income. So if you hold the property for over 1 year and then you sell, long-term capital gains rates is going to ensure that you're paying a maximum of 20% tax on the sale of the property on any increased value that you've created. Whereas if you sell it in under a year, it gets treated like an ordinary income does, which means the highest tax bracket at that point is 37% as opposed to 20. And then finally, the other thing to consider when you're getting into some of the different properties and investment types is, what are the tax credits and the energy credits look like? Is there any consideration of whether we're going to get a historical tax credit or a conservation easement credit for this particular investment? And this, again, is largely for people that need a large amount of depreciation on that front end. These are going to be important considerations for them. So you put all those pieces together and you have the very basics of, what do I want to be thinking about when I'm getting into a deal? Do I want to be a debt lender and have a little bit more of a fixed and predictable return on my investment? Or do I want to be an equity investor and maybe have a little bit less of the fixed and predictable return, but have a little bit more of the upside, have a little bit more of the tax consequence, which could be a tax benefit to a lot of people. From there, you're going to want to dive into, what does the property look like? What does the area look like? And most importantly, who's the operator? Because even if you're buying a property in a bad location, but if the operator knows what they're doing, they can make money on it, right? And even if you're buying a property in an excellent location at an excellent price, if the operator is not able to, maximize on that property or even operate it well, you may not return your money at that point. So while it's important to make sure that you're vetting the property in the area, I would argue that the most important thing that you need to vet is, who is the operator and what are they capable of? Have they done this before? Have they done it 100 times? Is this their bread and butter, or are they trying to do something different than what they normally do? Those are going to be important questions. From there, I guess, Tim, we can open it up to the question and answers and discuss anything that you all want to discuss.
Yeah, man, good stuff. And so, guys, these are questions that Fatty would ask, right? As somebody who's done hundreds of millions of dollars of commercial real estate deals and has raised over $100 million from investors, and who has a law degree, right? These are the questions that he would ask if he's getting into different deals. So do you think these are good questions to probably write down and reference whenever you're looking to make an investment or not, right? And so hopefully you guys took some notes or took pictures of the screen in order to get some good takeaways from that. If you didn't, this is on also streaming to Facebook. You can go and watch the replay on my Facebook page. But a couple of things that you said, Fatty, that sparked some thoughts and insight is like a lot of those questions are, you're asking kind of the overarching question is, are we in the same boat rowing in the same direction as the investor and as the operator, right? A lot of syndications are structured in a way where, the waterfalls are, hey, as soon as you hit your return, you're cashed out. Or as soon as you hit your return, I get, as the operator, get way more equity. And I'm talking hypotheticals. This is not how we structure. And that can be okay if it's a great deal, or if you're okay with whatever those metrics are and all that stuff. But a lot of times people don't even look at that. I think the dilution is a big deal too. I mean, I'm invested in a deal in March of 2018. This guy raised, I don't even know, it was $500,000 or $1 million. I think it was $500,000. Dude, he ended up having to raise another $600,000 because he missed the mark so bad, and it diluted my equity from X%, 5% down to like 2% of ownership in this thing. Instead of him diluting his equity because he's the one who missed the mark and screwed this whole thing up, and couldn't get it online. Fees, I think fees is another big one. There's you look at some of these syndicators, they take asset management fees, acquisitions fees, fundraising fees, capital events fees, refinance fees, right? Disposition fees, loan sponsorship fees, and they fee the deal to death. They take all their chips off the table. And then if the deal succeeds, great. If it doesn't, no worries. They already took all their money off the table, right? And so we don't do any of those things. I think there's a fair medium somewhere where, hey, listen, I got to keep my lights on too. So we do take an acquisition fee, but we don't take any of those other fees. And we make sure that the investors are treated very, very fairly. So that way, you're paying the operating expenses. Now you're paying the debt service. Then you pay the investors. And then after the investors get paid, now we do our equity splits. And so I'm fully incentivized to make sure that the investors get paid. So that way my team then gets paid. So again, we're asking, are we in the same boat, rowing in the same direction? And our goals and visions aligned? I think that's a really, really important point to make. And then the other thing is, and you alluded to this several times, but it's like, do I like the operator? Like that to me is, does this operator have the same values, right? Do they value honesty, integrity, shooting straight? Will they have a shitty, hard conversation with me because things don't always go right? In fact, that made me think of something else, and I'm going to talk about that in a second. And do they have good values? Are they going to actually work for it? Are they going to try to make things right? That's an important piece, right? Like we've had operators that just say, hey, throw their hands up in the air and they walk away. I sponsored the loan. Now my team's got to step in. They just didn't do their part whatsoever, and they didn't care about it. And we should have never partnered with those people. Now there's also another type of partner who does have good values, but maybe doesn't have the ability to get things done or get things to the finish line, right? Like I'm thinking about another deal. Guy wanted to help. He wanted to make a contribution. He wanted to support the deal when it went sideways, but he just didn't have any resource. He couldn't get things done. The resourcefulness was not there. The connections, the network was not there. And he couldn't go out and raise more money. He didn't have a team. He didn't have any of those things. And so I think about just having somebody with good values that whatever, go to church with, or you've known for a long time, and they'd help you out. But if they don't have the resources, they don't have the connection, the ability to do it, then it's for naught. And at the same time, they could be the money guy. They could be somebody with access to a ton of resources. But if they're a shitty person, then I'm not doing business with them, right? You need both of those values, both of those qualities, in my mind, where I would not do a deal with somebody unless they check both of those boxes. So I think that's very important. And then one other thought that you've seen a lot of it over the past couple of years is like, and you see it all at all times, right? We live in boom and bust cycles. And I'm watching the football playoffs, and I'm seeing playoff teams, some of the best teams in the entire country in playoff football and in baseball and in basketball, don't have undefeated records, right? Like they still have losses sometimes. Now they have more W's than they have L's, but they're still L's. And I think a sophisticated investor and a big business owner and somebody who's been around the block long enough understands L's will happen. The key, though, is how do you mitigate, how do you reduce the number of L's and increase the number of W's? How do you have more wins, less losses? Knowing there are going to be some losses and knowing that the person that you're operating with, the person that you're partnered with, is going to make you whole on that in some capacity, right? Had a deal that went south at a 44 unit apartment building, first apartment building I ever lost money on. And had a deal with the money guy. It was a 50-50 split. We ended up losing 50 grand on it. Not only did, he put in $250,000, he would have only gotten $225,000 back. You know what we did instead? I gave him back. I ate the whole $50,000, gave him back all 250, and then I gave him equity in another deal where he didn't have to bring any money. And now he sings my praises, and we're great friends, and we're going to do more deals together, all because I did the right thing, right? And so, what kind of people are you partnering with? Are they doing that? Are they willing to make you whole if they lose your money or if something goes sideways, or what is it? Or are they saying, hey, you're a grown up, you're a big boy, you're a big girl, too bad, too sad. And what does that look like? So I've lost a lot of money on deals before, but none of my investors have ever lost money on deals where we weren't able to like redirect it or get them their money back in another way. So something to pay attention to. How do they handle themselves? And I think when the tide goes out, you see who's swimming naked and you see how people respond. So now's a good time to figure out how people are responding. And it hasn't been easy. There's been a lot of sideways stuff. Like if people talk about interest rates, I think insurance costs have adversely affected this industry more than anybody else, more than any other variable. Insurance is something that doesn't go away. Interest rates you can always refinance in the future, but insurance is tough. So there's that. The labor force, there's still supply chain issues, right? There was an eviction moratorium for a year and a half after COVID that caused a lot of issues, especially with the value add stuff that we dealt with. So, but how are people overcoming that, right? Are they crawling up in a corner and not getting stuff done? Are they trying to figure things out? Are they diluting their own equity as opposed to their investors' equity? And I think that's all important stuff to weigh out. So we have about 10 minutes left, open for Q&A. What kind of questions do you guys have for myself, for Fatty? Amanda's still on here. She can answer some questions. Whatever you guys have, let's put it in the chat box and ask, right? And
Tim, I see a good question already from Dwayne, and I'll try not to take over the last 10 minutes here answering it. I'll try to give the brief answer as opposed to the full legal answer, right? But the question is, does a promissory note get classified as a security if it's not filed? So the answer is yes, a promissory note in and of itself is a security. However, you can exempt it from being a security by having collateral attached to it. What does that mean? Generally, if you're putting a promissory note in conjunction with a mortgage on a property, you are no longer creating or it is a security, but you are no longer required to register that security because you have attached that collateral and therefore met the exemption requirement. So in that case, even though it still is a security, technically, there's no requirement of filing as a result of the fact that you had a mortgage that was filed against the property. So that's the easiest way, especially for in the single family world, the most common way that you kind of stay out of the requirement for filing with the SEC, mortgage on the property.
What about a personal guarantee? Is that considered collateral?
Oh boy, that's a question that you got to ask your SEC attorney because some of them are going to have different opinions on what is going to rise to the threshold of being collateral enough. And that's one of those questions of, well, it really depends. I've never seen case law or regulation that says whether it is or is not. And so I don't know the answer to that.
Mm-hmm. Yeah. And what I've found or what we found is some SEC attorneys are very liberal in the, hey, here's what you can do. Here's what you can't do. Here's what you can say or not say. And then other ones are very rigid and say, no, you got to stay inside. And there's a lot of gray area that isn't fact or fiction or has case law behind it, like Fatty's saying. It depends on your level of risk aversion, I guess, right? Like, what do you believe? I don't know. Can you defend yourself? Like what would you? how would you respond to this post or this situation in front of a judge, right? I asked myself that, like, how would we respond to this if it had to go in front of a judge? Let's make sure we respond the best way possible of what a judge would be looking at and or jury would be looking at if we ever had to defend this decision that we're making right here. So yeah, good questions. Scott, self-directed IRA through equity trust. Are there any issues with leveraging these monies for syndication?
Nope.
Furthermore, are there strategies with syndications that work similar to standard 1031 to push capital gains exposure down the road? Fatty, can you answer that?
Yeah, so starting with the first one, is there any issues with leveraging your IRA money for syndications? No. The only thing that you would not be entitled to the depreciation, right? So if you were investing in your personal name, you could get a bunch of depreciation by investing in a syndication or in real estate. When you're investing through an IRA, you would not be entitled to that. But I mean, it shouldn't be a deterrent from investing through your IRA unless you're specifically looking for depreciation, right? As far as strategies with syndications that work similar to 1031, there is a strategy that I can think of, and that is, hey, you buy a property, you don't 1031, but you sell. You just buy another property and you cost segregate it, right? That's another strategy in order to keep the taxation, the amount of tax down, or just 1031. The syndication itself could 1031. It's not a common thing, but it is a very possible thing.
Yeah, from my perspective, I've done 1031s before. First of all, when you're syndicating, there's a lot of people involved. It's hard to get everybody on the same page and wanting to participate in a 1031. Some people want their money back, some people don't. Can you buy some people out? Yeah, I guess you could. It's just there's a lot of complexities and moving parts with that when doing a 1031 on syndication. If I owned it outright and it's just me and my company and I was the investor and I got the loan myself and everything else, I would be much more inclined to do more 1031s. The other thing is I've seen people make bad decisions from 1031 property. And so they have their back against the wall, or they have to identify and then they have to move on a property that's not necessarily a good deal. And they trade out of a deal that they had understanding of, they were familiar with, right? They know what the hair on their existing deal was. And then they trade it out and get into another deal that is an unknown. It's a question mark. And then they got to uncover the aspects of that deal that they didn't know about and create additional risk and create additional liability. And maybe the returns aren't as good as they thought they were. And maybe they should have stayed in their original one. So depending on what that looks like, my philosophy is it only costs probably like, I don't even know what it is today, but like $1,500, $2,000 to at least do the SEC paper, or not the SEC, the 1031 paperwork, and then put the money with a custodian. If you find something in that 45-day identification period, great, move forward with it. If you don't, who cares, right? Like, and just take that money and find something else to deploy it into. I think that at the beginning of the year right now, you got plenty of runway to find more deals for the next 11 months. To Fatty's point, you buy it, you can cost seg it, accelerate depreciation, and offset a lot of your capital gains anyways that way. If it was at the end of the year, I would probably throw it into an exchange to at least buy a little bit of time into the beginning of the next year in case I can't find something. But at the end of the day, man, I think it's one of those things. Like, depreciation's awesome, but when you learn about like recapture of depreciation, it's less awesome, and a lot of people don't understand that next level of it, like Fatty was explaining in some of the questions on what does the recapture look like. If you're going to accelerate depreciation on a deal, you probably want to hold it a little bit longer, unless you have another
depreciation's awesome, but there's a reason why they tell you that the most important thing when you're investing is location, right? Like depreciation matters. It is something to build into your calculation, especially if you're a little bit more sophisticated. However, it is not the first, second, third, fourth, or fifth thing that you should be looking at. The number one thing you should be looking at is, other than Annabelle, because she's super cute, is this a good deal? Plain and simple. Do not make the decision based on the depreciation. Do not make the decision based on not having to pay that tax on a 1031, right? Make that decision based on, is this a deal that I want to hold on to for the next 2 years, 5 years, 10 years? Am I buying it at a basis that makes sound sense to hold on to it?
Mm-hmm. Good insights. Good insights. What are the questions you guys got? A couple more minutes if you want. The other thing I'd say is just a reminder, if anybody is interested in coming out and meeting Amanda and coming to the finance and show me the money themed mastermind event that we're hosting in New Orleans, again, we'll put the link over here in the chat box, and I'll post it on the Facebook post as well. So that way you guys can check that out. Come out, check out our mastermind. Legacy Family is an unbelievable group of rock stars who are out there doing a lot of deals. And as good as business people as our members are, they're even better human beings. I'm super proud to be judged by the people that are in that mastermind. They're all rock stars. So,
and it's also needs to be said that we probably have more fun than any other group out there too.
Oh, we definitely have more fun. We have a blast. So, good stuff. Well, I appreciate you guys being here. Hopefully you got a ton of great value, ton of great insights. Took some notes on today's masterclass, if you will. And if there's ever anything that I can do to support you or Fatty, don't hesitate to reach out to us. And let's go build some wealth together. And by the way, we have deals too, right? And there's deals in our network. So if you're looking for specific kinds of deals, if we have something great, if not, I could probably make an introduction for you. Like yesterday, there was somebody who needed a loan sponsor on a $13 million development deal. I made a few email or text message introductions, boom, and they're all set up, right? So if I can be a resource in any way for you guys, don't hesitate to reach out and utilize us, right? That's what we're here for, in order to help you guys build some wealth and do some business together and make an impact together. So appreciate you. Have a great weekend. Be safe. Be your best. See y'all.